Welcome to the Deep Dive. Today, we're embarking on a really fascinating exploration. We're pulling insights from an article published in the Motley Fool. This is August 30, 2025, and it's titled, Where Will Costco Stock Be in 5 Years? By Leo Sun. Our mission isn't just to tell you what the article says, but to truly unpack why Costco, a company so many of us frequent, has become such an economic powerhouse.
Right.
And maybe what its journey might look like going forward, especially when, well, this stock might seem a little pricey. Get ready to maybe rethink how you see this retail giant.
It's a fantastic choice for a deep dive, I think, because, on the surface, Costco seems pretty straightforward, doesn't it? Buy in bulk, save money.
Yeah, simple enough.
But as we peel back the layers, you'll discover just how incredibly resilient and strategically brilliant their business model truly is. What's most compelling to me is how effectively it has navigated and even thrived through some very turbulent economic waters.
So let's jump right in then. The article kicks off by highlighting Costco's absolutely astonishing performance. I mean, we all kind of feel the buzz when we shop there, right?
Definitely.
But the numbers are truly staggering. Over the past 5 years, its stock rallied a massive 174%.
Wow.
That absolutely crushed the S&P 500, which, while still strong, rose only 86% in the same period.
Big difference.
Huge. And here's the kicker. This phenomenal growth wasn't exactly in smooth sailing conditions. We're talking through the chaos of the pandemic, persistent inflation, rising interest rates, even geopolitical conflicts. So the big question is, how on earth did they manage that?
Well, this level of success, especially in such challenging times, it's definitely not an accident. It's fundamentally woven into the fabric of their, unique business model.
Okay.
At its very core, Costco's strategy hinges on its members paying those annual fees, right? Just for the privilege to shop there.
Right, the membership.
Exactly. And the real insight here, what makes this so powerful, is that these membership fees are incredibly high margin revenue, like almost pure profit.
Ah, yeah.
This structure then frees Costco up to do something truly radical in retail. They can afford to sell their actual products at nearly break-even prices, or maybe with very thin margins. This isn't just a pricing strategy, it's like a strategic weapon. It fosters intense customer loyalty, consistently low prices for you, the shopper, and creates this powerful self-reinforcing cycle of commitment.
So members kind of invest in their own loyalty.
Pretty much. And the more they shop, the more value they feel they get from that annual fee. It becomes incredibly hard to just walk away from that perceived value,
That's truly ingenious. Most retailers make their money on the products, but Costco basically charges you for the privilege to buy. It's a total flip of the traditional retail script. But is that singular membership fee really enough to create such fierce loyalty? Especially today, I mean, the retail landscape is incredibly competitive. What other unique levers do they pull to keep people so locked in?
That's a great question because you're right. It's definitely a multifaceted approach. It's not just the fee.
Okay.
Beyond the membership fee, they leverage their immense scale. We're talking hundreds of warehouses, millions of members, to negotiate incredible bulk rates with suppliers.
Right. Buying power.
Huge buying power. This further cements their ability to offer those famously low prices. They also intentionally limit markups on their products, reinforcing that value proposition day in, day out.
And Kirkland. Can't forget Kirkland.
Oh, absolutely. Kirkland's signature, their private label, it's not just positioned as a cheaper option, it's heavily promoted as a high-quality alternative to national brands that builds trust and offers even more value.
Yeah, I mean, why buy the name brand when Kirkland is often just as good, sometimes better for less? I swear by their coffee beans.
Right, exactly. But it's not just the products, is it? Like you said earlier about the buzz.
Yeah, I always find myself finding something I didn't even know I needed until I saw it.
Exactly. That's their brilliant treasure hunt strategy in action. They intentionally rotate a narrower, ever-changing selection of goods.
Okay.
So you go in for paper towels, but then you stumble upon an amazing deal on, I don't know, a kayak or some gourmet cheese assortment you absolutely must try.
Guilty.
It keeps you coming back, not just out of necessity, but out of curiosity and the thrill of discovery. It prevents that sort of shopping fatigue. It's almost like a little adventure every time.
It really is.
And finally, let's not overlook their ancillary services. The food court, that legendary hot dog and soda combo.
Can't beat it.
The gas stations, the optical and hearing centers, the tire centers. These aren't just minor conveniences. They add incredible tangible value that makes that membership fee even harder to justify not renewing. It's a whole ecosystem designed for stickiness.
Okay, so we've broken down how the model works in theory. Now, the article gives us the actual proof, digging into some really revealing numbers. This is where it gets truly fascinating for me.
Mm-hmm.
It highlights 4 key metrics that demonstrate just how robust this model is in practice. Comparable sales growth, the expansion of new warehouses, total cardholders, and those global renewal rates.
Yeah.
The consistency in these figures, from fiscal 2020 through 2024, is seriously impressive.
Absolutely. When we look at these numbers, they tell a very powerful story, not just survival, but like sustained growth. Let's break them down a bit.
Yeah.
First, adjusted comparable sales growth. This is a key indicator, right? It shows how much sales are growing at existing stores, but it strips out the noise from fuel prices and foreign exchange rates.
Got it.
It remained consistently healthy. It ranged from a really robust 9.2% back in fiscal 2020, then it dipped a bit to 5.9% in fiscal 2024 as maybe the pandemic boom eased off.
Right. Understandable.
But then, remarkably, it picks back up to a strong 8.1% in the first 9 months of fiscal 2025. This just shows their incredible ability to adapt and regain momentum, whatever the economic weather.
And their physical footprint keeps growing too, doesn't it? More stores mean more opportunities.
Precisely. In terms of physical expansion, their total number of warehouses steadily increased. Went from 795 in fiscal year 2020 up to 890 by fiscal year 2024.
Wow.
And they didn't stop there. They hit 905 by the end of Q3 fiscal 2025. That consistent strategic expansion provides new avenues for growth and brings the Costco experience to more people globally.
But for a membership model, the real acid test isn't just sales or new stores, is it? It's about how many people are signing up, sure, but more importantly, how many are staying. What do the cardholder numbers and those renewal rates tell us?
That's a crucial distinction, absolutely. And the data here is just as compelling. Total cardholders grew steadily from 105.5 million in fiscal 2020 to an impressive 136.8 million in fiscal 2024.
Huge numbers.
Huge! And then climbed even further to 142.8 million in Q3 fiscal 2025. So the base is constantly expanding. But to your point about stickiness, the global renewal rate.
Yeah, that's the key one.
It really is. It's a fantastic indicator of member satisfaction, how much value they feel they're getting. It consistently climbed from 88% in fiscal 2020 to a stellar 90.5% in fiscal 2024. And it held strong at 90.2% in Q3 fiscal 2025.
Over 90%. That's incredible loyalty.
It really is. These figures demonstrate very strong customer loyalty and perceived value, which, as we've discussed, is the absolute bedrock of their business model. It's a testament to the value they deliver that so many people keep paying that fee year after year.
It's almost like their business model makes them, bulletproof against economic headwinds. The article points out, Costco thrived during the pandemic, people stocking up on essentials.
Right.
And then during the high inflation period from 2021 to 2023, cost-conscious consumers just flocked there seeking value. It's like they're built for any economic condition.
It certainly seems that way.
But what about their pricing power, though? Did they actually raise those critical membership fees during this period of high growth and inflation? Because that's a big test for a membership model like this.
They absolutely did. And this is a really significant marker of their pricing power. Costco raised their membership fees last September, first time in 7 years.
Okay, so quite a while.
Yeah. And critically, that price hike did not throttle their growth or negatively impact those already high renewal rates we just talked about.
Wow.
If anything, it just shows the strength of their relationship with their members. This is a powerful indicator that they probably have more room to raise fees in the future without alienating that loyal base, which is quite remarkable in today's retail world.
Speaks volumes about the value people see in that membership.
Undeniable value, yeah. Customers were willing to pay more.
Now, let's pivot slightly. There's a point in the article that seems a bit counterintuitive about their financials.
Yeah.
Despite all this growth and pricing power, it mentions Costco's gross margin actually dipped a bit. For a lot of companies, that would be a huge red flag, right?
Yeah.
How do we square that with their strong overall performance? How does that work?
That's a crucial question. And it's where the nuance and, frankly, the strength of their model really shine. While gross margin, which is basically the profit they make just from selling products before operating expenses,
Right.
it did dip slightly from 11.2% in fiscal 2020 down to 10.9% in fiscal 2024. But it was due to several understandable factors.
Like what?
Well, general inflation increasing their own costs, obviously, their intentional strategy of low markups to keep prices down for members, the expansion of their e-commerce business, which tends to have lower margins than in-store sales, and even currency headwinds affecting their international operations.
Okay, so understandable pressures.
Exactly. But here's the critical part. Despite that slight margin pressure on the goods themselves, their earnings per share, or EPS, that's essentially the bottom line profit Costco makes for each share of its stock.
Right, the number investors watch closely.
Precisely. That EPS still grew at a fantastic compound annual growth rate, or CAGR, of 16%.
16%. Wait, can you quickly unpack KGR for us again? What does that mean in practical terms?
Oh, sure, yeah. Compound annual growth rate, CAGR. Think of it as the smoothed out average yearly growth rate over a specific period, like in this case, fiscal 20 to 24.
Okay.
It gives you a clearer picture of the consistent trend rather than looking at maybe big jumps or dips year to year, which can be more volatile. So a 16% CAGR for EPS over that period is very, very strong. Consistent, powerful profitability growth.
Got it. Thanks. So how do they pull off that impressive EPS growth even with a dipping gross margin? That still feels a little like financial magic.
Huh. Less magic and more just smart business mechanics, really. The strong EPS growth happened for a few key reasons.
Okay.
First, their robust overall sales growth and that swelling base of high-margin membership fees more than offset the slight margin compression on the products themselves. Basically, the sheer volume of sales and that fee income just outpaced the lower profit per item.
Volume and fees save the day.
Exactly. Second, they directly benefited from those membership fee increases we just talked about that flowed right to the bottom line. And third, their massive scale helps dilute operating expenses. As they get bigger, certain fixed costs like administrative overhead become a smaller percentage of their total revenue.
Economies of scale.
Precisely. So yeah, despite some pressure on gross margins from actual product sales, the overall financial picture strengthened considerably. It really showcases the powerful leverage built into their unique model.
Okay, so we've seen the past performance, we've decoded the current health of the business. Now, let's look ahead. What does this all mean for Costco's future over, say, the next 5 years? The article tries to peer into that crystal ball, laying out analyst expectations.
Right. Looking forward, the projections remain quite stable and positive. Analysts generally expect Costco's net sales and EPS to continue growing at a CAGR of around 8% and 10% respectively. That's looking out from fiscal 2024 to fiscal 2027.
Still pretty healthy growth.
Very healthy, yeah. And this projected stable growth is anticipated to be driven by basically sticking to their playbook. They plan to keep opening 25 to 30 new warehouses, annually consistent new growth avenues.
Okay.
They're also continuing strategic investments in their e-commerce ecosystem, enhancing their digital presence, because even a brick-and-mortar giant needs a strong online game these days.
Sure.
Plus, they're expanding their logistics network to improve efficiency, cut costs, and of course, they're banking on the ongoing stickiness and value of those ancillary services we discussed. It's a pretty well-defined growth trajectory based on strategies that have already proven successful.
That certainly sounds like solid, consistent growth, just building on everything we've talked about. They're not like reinventing the wheel, just executing really well on what works.
Pretty much.
But the article also brings up a potential yellow flag, maybe, especially for investors looking to jump in now. Valuation. Even a great company can be a problematic investment if the price is too high.
Yeah. Precisely. And this raises an absolutely critical question for investors to grapple with. While the underlying business fundamentals are undeniably strong, resilient, well-managed, Costco's stock isn't cheap right now.
How not cheap?
Well, the article highlights it's trading at 52 times this year's earnings. Now, the price-to-earnings, or PE ratio, is a classic metric.
Right. Tells you how much you're paying for profit.
Exactly. How much investors are willing to pay for each dollar of a company's current profit. A higher PE usually signals that the market has very high expectations for future growth.
And 52 is high.
Yeah, 52 is quite high historically for retail, even for a quality name like Costco. To put that in perspective, the article points out that just at the beginning of calendar 2023, its forward PE, so its valuation based on expected earnings in the next year, was down in the low 30s.
Wow, big jump.
Big jump. That leap to 52 suggests that a huge amount of future success, that 8–10% growth we talked about, might already be baked into its current stock price. The market has already priced in a lot of that expected solid growth.
So given this combo projected solid growth, but also this rich valuation, what's the article's ultimate projection for Costco's stock price over the next 5 years? What does the author conclude?
The author provides a calculated projection based on those analyst estimates. If Costco meets Wall Street's forecasts, keeps growing its EPS by that 10% CAGR over the next few years.
Okay.
And this is a key, if its valuation adjusts down to a more reasonable, though still pretty healthy, 35 times forward earnings by 2030.
Right, a PE normalization.
Exactly. Then its stock price could still rise a decent 20% to around $1,140. Now, that's a respectable gain, no doubt. For many investors, a 20% return over 5 years, plus maybe some dividends, would be perfectly acceptable from a stable company.
But,
But the author importantly concludes that it probably won't come anywhere close to matching that extraordinary 174% return we saw over the past 5 years.
right, lightning doesn't strike twice in the same way.
Pretty much. It's a classic case of balancing the quality of a truly great company with its current market price and the high expectations already built into it. The potential for future growth is there, but the era of those outsized, explosive returns might be less likely simply because so much success has already been anticipated by the market.
So we've gone on a true deep dive into Costco today. We've seen how its incredibly resilient membership model, combined with clever strategies like that treasure hunt and those valuable ancillary services, has allowed it to achieve really surprising growth through some tough economic times.
Yeah, really impressive resilience.
We've also unpacked its solid future projections. Yet as we close, the current valuation presents, well, a complex picture for anyone looking at its stock as an investment right now.
It truly highlights a fundamental challenge in investing, doesn't it? How even the most fundamentally strong, best-in-class companies can reach a point where their market price reflects and maybe even fully anticipates much of their future potential. It creates a different kind of investment question. You're moving perhaps from discovering a rising star to evaluating the price you're willing to pay for consistent excellence.
Which leaves us with a provocative thought for you, the listener, to consider as you make your own informed decisions. How much value do you personally place on a proven track record of resilience and consistent growth when that very success might already be fully priced into a company's current market value? What does this tell us about the market's appetite for reliability, maybe even predictability, even if it comes at a premium price? It's something to ponder about, that interplay between solid business fundamentals and ever-shifting market sentiment.